The next few years are likely to be the years of highest growth in the world in decade. That transformation, which is based on infrastructure, and as you said, is based on the energy transition, it requires a lot of metals. And I mean, if we have this, very bright prospect for base metals, has it already been priced in? The answer is no.
Hello to viewers tuning into this virtual investor discussion that forms part of One-to-One Money Investment America's online event. I'm very pleased to host today Jose Martinez Sanguinetti, who is CIO and Executive Vice President of Investments at Rimac Seguros, one of the largest insurance and reinsurance firms in South America, I believe. Jose joins us from Peru today. So Jose, thank you and good morning.
Good morning. It's good to be here. Thank you very much for the invitation.
Thanks for taking time, Jose. Yeah, it's really interesting for us to speak with you because, you're a CIO of, looking after a large portfolio with a huge assets under management. And you obviously look across many different sectors. I wonder if you could firstly talk about your investment mandate, sort of regionally, how you look at maybe equities, bonds, split everything up, and then we can get into where commodities and metals and mining might play into that as well.
Oh, great. I'm the Chief Investment Officer for Rimac Seguros, which is one of Peru's largest insurance companies, and indeed, it happens to be one of the largest in South America as well. I run a portfolio that is basically amounts to $3.5 billion at the moment, which is largely invested in fixed income across the world. We issue policies in both Peruvian soles and US dollars. So a large chunk of our portfolio is invested abroad in order to hedge that currency exposure. We invest in around 17 countries distributed around the world, including South America, North America, Europe, and Asia. Though most of our exposure is concentrated in the Americas. We also invest in equities. We invest in equities also on a global basis, both in ETFs, basically executing global strategies that seek to provide strong capital appreciation to our insureds. And also, we hold proprietary positions in mainly firms in Peru, Chile, and in the United States as well. We do that for trading purposes, and we also hold some structural positions in equities. Another important side of our investment strategy is infrastructure, which we also do on a global basis, both in the public markets and in the private markets. We do that, we invest through a co-investment vehicle that we have created. And from there, we invest in countries like Australia, Germany, the United States, but also Chile and other countries in the world. So we do have exposure to both equities and fixed income. And to be honest, our exposure to equities is larger today than it has been in the past, basically in response to current market dynamics. We see that the next 10 years are going to be largely equity years. But on a global basis, we are likely to see, given the fact that we are likely to see very low interest rates around the world over the next, I dare to say, more than 5 years, equities are likely to benefit from that, from the lower cost of capital and easy monetary policy, along with world growth.
Yeah, absolutely. That sort of leads on to some of my next question was going to be around, from where you sit, how's your view of the global recovery? You're obviously expecting, lower rates. Bonds are not as attractive as they had been previously, and so hence the weighting into equities. But are there other macro factors that you would just like to highlight as to how you see the post-pandemic economy moving? And obviously, we appreciate it's different within the regions, but it'd be interesting to get your perspective as a CIO, how you see the global recovery shaping up.
The next few years are likely to be the years of highest growth in the world in decades. I mean, we're not only likely to see an unprecedented period of growth, but we're also likely to see a period of uneven growth, determined to a great extent on the success of the different vaccination efforts around the world. And the countries that have been most successful in dealing with this global pandemic are already seeing very strong recovery rates. And some countries are lagging, but are likely to see those recovery rates also, which, I mean, the fact that, I mean, the growth will be staggered a long time in response to how fast vaccination efforts move, are likely to make this period of growth a prolonged period of growth. In fact, I mean, the International Monetary Fund is expecting the world economy to grow 6% this year, which is largely higher than the potential growth of the world economy. And it's also expecting to see those rates sustained over the next few years. I mean, even in 2022 and maybe 2023. So, I mean, the fact that these very strong growth rates are likely to be sustained over a prolonged period of time provides an enormous opportunity for investment in higher risk assets like equities. Now, the fact is that, I mean, the environment is favorable to equities also, because we are likely to see very strong growth in the absence of significant inflation. The world has gone through an inflation scare over the last few months, but after the statistical base effects of having very strong growth after a year of very strong contraction pass through the inflation numbers, we're likely to see that inflation reverts to the very low levels that we saw in the past. I mean, and the main reason for this is that the low inflation rates that we have been seeing over the last decade are driven by forces that still exist and that actually have been exaggerated or increased by the pandemic. I mean, some of those trends, I mean, the fact can be mentioned. One of them is the fact that a great deal of the growth in the world today is being led by Asian economies, and the growth in Asian economies is being led by productivity growth. Productivity growth that derives not only from innovation, technological innovation, but derives to a great extent from the change in the social structure of those countries. I mean, those countries are becoming more industrialized. Those countries are becoming more urbanized, and in that sense, the standard of living and the average incomes of those populations are increasing, which leads to a change in their consumption patterns. But because it's sustained by productivity growth, or because it's sustained by the growth in their ability to produce and take a better advantage of their own abilities, that growth does not generate inflationary pressures On the other hand, I mean, we have a substantial force generated by the transformation of the energy industry in the world. I mean, we're moving from oil to renewables. Yes. And renewables have a lower marginal cost. I mean, once you use them to generate energy, they may require a higher investment at the beginning, but their marginal cost of generation is lower. So that, I mean, reduces also the cost of energy, which is one of the main components of production cost. Yeah. If you add to that low interest rates, if you add to that the effect of, I mean, the advance of the digital technologies, the advance of robotics, and you get a combination of factors that are likely to exert downward pressures on prices in the long term. So, and also, I mean, another factor that is important is the effect that economies like Japan and the European Union exert on the rest of the world. I mean, because of their own population dynamics, inflation is not likely to rise in those countries in the near term. They're likely to keep very low interest rates, and those very low interest rates, by arbitrage, generate downwards pressures on interest rates around the world.
Yeah, it's an interesting time. Yeah,
please go ahead.
We haven't seen rates this low for a long time in the UK, certainly, and it's, you know, there's no sign of them increasing. You touched on some really interesting points there, and I want to just hone in on the infrastructural build out that we might be witnessing in this sort of decade of growth that you mentioned, but also the energy transition, as you spoke about renewables. And before we talk about some of the inputs to that, you know, do you see these two themes as perhaps what's fueling this sensational growth that we're going to be seeing? You know, the pandemic's changed a lot. We're seeing transitions from hydrocarbons to electrons, electric vehicles, and infrastructure build out, improving the US grid, for instance, after the disaster that we saw in Houston, for instance, is an example of how grid infrastructure needs to be improved. And then, of course, the Asia economies, as you mentioned, increasing their purchasing power, but also sophistication of their own infrastructure. Do you think that the infrastructure and the energy transition are both this sort of driving force for this growth?
Yeah, I see four driving forces actually.
Okay.
The first one is easy monetary policy, which we have already mentioned. The second one is fiscal policy. I mean, the fiscal effort, substantial fiscal effort, which is likely to be focused on infrastructure, both in the United States, also in China, and in many other places in the emerging world. The third one is private investment. I mean, we have gone through a period of very low private investment over the last 5 years, and particularly over the last 2 years. So there's a gap in capex that has accumulated over the last few years that needs to be corrected. In the third place, I mean, we have the transformation of the energy industry, and that is likely to lead to a substantial increase in capex. I mean, you need to change the whole energy distribution network. You need to change, I mean, you need to create the facilities for electric cars to charge their batteries. You need to create the batteries, you need to create the cars. And most large economies in the world have already set a deadline to replace petrol and gasoline propelled motors for electricity propelled engines. So, and that should lead to a substantial change in the world energy infrastructure that needs to be built from scratch. And the good thing of that is that that transformation, which is based on infrastructure, and as you said, is based on the energy transition, it requires a lot of metals. It requires steel for construction. It requires aluminum for cars. It requires copper for construction and cars. It requires nickel for batteries. It requires lithium for batteries. So we're likely to see a prolonged period of strong demand for base metals. As a matter of fact, I mean, some analysts in the market have already named the next decade as the decade for base metals.
Yeah, it's interesting. Certainly. How do you then, as a CIO of portfolio manager, do you look to capitalize on some of these themes? You mentioned you're more into equities at the moment, given the global situation. Does that mean that a base metal producing company, for instance, is suddenly a far more likely prospect for investment at the moment?
Yeah, yes, definitely, because they're likely to see a very strong growth in earnings over the next few years, particularly because they come from 2 years where their earnings have been diminished substantially. And also because the trends that we mentioned before are likely to drive volumes and prices much higher, and that should reflect in stronger economies of scale and higher earnings. I mean, we, for instance, can expect mining firms, as measured by the Bloomberg Mining Index, we can expect mining firms in the world to more than double their earnings in 2021, and they're likely to see much higher earnings over the next few years. Which leads to the next question. I mean, if we have this very bright prospect for base metals, has it already been priced in?
Yes.
And I think the answer is no. I mean, the answer is no, because if we believe that we are facing a prolonged period of higher base metal prices, we're likely to see sustained levels of earnings, I mean, higher earnings in the future. And if you look at indicators of valuation, for instance, like price to cash flow, once you take into account earnings growth, expected earnings growth, price to cash flow and as measured by the Bloomberg Mining Index is around 7.5, which is very low by historic standards, and it's low if we take into account the expected growth rate of that cash flow generation is very high. Also, if you look at price to earnings, they look high if you compare prices to earnings over the last 12 months, but we already know that those 12 months are badly affected by the pandemic. But if you look at price to earnings on a forward-looking basis, they're around 11.5 for the whole mining industry, and that's not expensive at all.
Yeah. So there's some really undervalued opportunities potentially there, and if we think back to the last sort of boom China-led period of the 2000s, obviously very different global scenario, but an interesting time, to be weighted into commodities or metals companies. This time around, you've talked about the sort of broad mining sector, but is there a particular segment of it that you at Rimac are particularly interested in? Do you like base metals? Do you like copper? Is it about finding quality copper companies, which is quite hard at the moment? Do you like some of the metals that are aligned with Peru, for instance? Gold, silver, other base metals. Can you be more specific?
Yes, definitely. Copper is maybe our favorite bet. We see a substantial increase in demand for copper. And we also know that there hasn't been a lot of new capacity entering the market over the last few years. Yep. So it's a combination of much stronger demand and very low capex over the last few years that are likely to lead this industry into a boom over the next few years. Now, in mining, and probably the one of the main concerns that you have when looking at a company is what their cash cost is. And there are some very good opportunities in copper. I mean, firms that produce at very low cash costs, as you mentioned in Peru, but also in Chile. Those are two countries that have a natural advantage because of the high grade of their concentrates. Also, I like very much iron ore because it's linked to the boom in steel that is expected to come along with infrastructure construction and with the urbanization of Asian countries.
Mm.
I believe that should drive iron ore to a very significant boom over the next few years. Those are the two that I like the most, that I see most immediately rising. There's other bets that I also like, which is nickel, because it's used for electricity batteries, and lithium, because it's also used for the production of electricity batteries. And in particular, lithium is a resource that is rather scarce around the world. And I mean, the large fields producing lithium are concentrated in very few regions in the world.
Mm-hmm. Yes, absolutely. Lithium, there seems to be a lot of it, but you got to get the concentrated, fine quality lithium to go into the batteries, and that's a whole chemical process on top of the mining as well. It's interesting. So that was my other question, really. How does the energy transition affect your business? I guess you talked about it being one of the drivers for growth this time around, but does it require a lot of repositioning? Is there a lot of does it impact the portfolio strategy?
Our portfolio we have been investing in renewables for quite some time. I mean, a great deal of this infrastructure effort that I have mentioned has been concentrated in renewables, and we are investing more and more in renewables at the time. I'd say it's not only renewables, we are also investing heavily into natural gas, because out of the hydrocarbons, I mean, that is the one likely to remain in high demand over the future because it's a cleaner source of energy.
Yeah, it's the stepping stone, I understand. Before getting to full renewables or full nuclear, you move from oil to natural gas.
Yeah, and then you have hydroelectric power, in which we have been investing heavily, because hydroelectric electricity generation is very large in Peru. And also we are investing now in also solar energy generation, and also in wind energy generation. It's interesting to see that even in emerging markets, I mean, most of the efforts to develop energy generation infrastructure today are focused, largely focused in solar and wind.
That's good.
So excellent. Yes, I mean, it does generate a challenge, but we have been taking advantage of that challenge for a few years already. Now, one of the main issues in energy transition is the fact that cars that are driven by electricity use as much as 4 times more copper than cars that are driven by gasoline and petrol.
Yes.
So the demand for copper is likely to increase substantially over the next few years as the world moves into a oil-free transportation industry. It will not be entirely oil-free because planes will still use gasoline, and maybe ships will still use petrol. But a great deal of the demand for oil in the world, I mean, close to definitely more than 40% of the demand for oil in the world comes from ground transportation, and that is likely to be replaced not very quickly, but over the next few years by electricity and batteries.
Yeah, it's a fascinating time and lots of change, and lots of potential avenues for opportunities as investors. Tying in with the energy transition and the move to decarbonisation comes the broader mandate of ESG. And I just wanted to ask, how with the changing landscape for ESG, how are you reacting to that as a CIO? This has obviously been a driving theme for the investment space, or an enhanced theme, sorry, for the investment sector over the last sort of 2 or 3 years in particular. It's come to light. How is ESG changing your role as CIO?
I think it's very important, and definitely we don't see it as a social responsibility issue. We see it as a risk management issue, and
Right.
that's very important. And because there's substantial evidence that ESG investments are more profitable over the long term. B, firms that are not compliant with ESG regulations and the ESG standards are likely to see their position in the market threatened over the next few years. So, I mean, it is a world the world over the next decade is going to be a world in which firms become very conscious about ESG in order to secure their own survival. As we are an insurance company, we're long-term investors, so we have to look at very long-term issues that drive or could threaten the stability and profitability of our investments. And if we did not pay attention to ESG, we would probably be running very serious risks over the long term. So we adopted ESG standards a few years ago. And I mean, we're moving slowly into having a world-class ESG asset selection process. We have incorporated a large number of criteria that actually drive our portfolio towards ESG standards. Most of the infrastructure investments that we have made over the last few years are ESG compliant, and we are very cautious about keeping that standard and improving it. As a matter of fact, we have turned down investments in carbon electricity generation facilities over the last few years. We have turned down investments in other industries that are not ESG compliant. Even the mining sector. I mean, ESG is very interesting in mining because mines have a bad reputation for not being too careful about the environment. Now, I have to say that bad reputation is not justified at all. I mean, there's a number of large mining firms around the world that are very conscious about ESG standards, and it is those firms that we look at with most interest.
Yeah, absolutely. It's interesting because the nature of extractive industries and natural resources requires such sensitive issues around community and resource. ESG can actually be done very well by a mining company, but not necessarily reported or marketed or shown that well. And there's been a sort of a period of repositioning what mining brings to the world and some of the good practices that's going on at the moment. So that's a great point. My final question was actually around precious metals and whether you have any sentiment for precious metals, and also how do you hedge within your portfolio? Is physical gold something that you would look at, or gold and silver, precious metal mining equities, for instance? Do they look attractive as a CIO of such a broad portfolio as a hedge?
Well, we do invest in gold mining firms on an on and off basis, also in silver mining firms on an on and off basis. There's this negative correlation between base metals and precious metals. that holds over very long periods of time, because base metals go up when there's certainty, optimism, and growth around the world. And that generally coincides with low inflation environments. And precious metals go up when inflation is rising, when there's uncertainty, and when there is prospects for growth become less optimistic. So in a sense, I mean, they hedge each other. And I mean, we have just seen a very strong rally in gold over the last 2 years. I believe that over the next 2 to 5 years, base metals are likely to outperform precious metals substantially. Basically, because the themes that we're talking about an environment of high growth, low inflation, and certainty deriving from the fact that, I mean, if you look at economic policy around the world, is to a great extent coordinated. I mean, interest rates are low everywhere in the world, in every currency. I mean, they're converging towards zero in every currency. Fiscal policy and fiscal deficits are high around the world because most countries are responding to the pandemic with very strong fiscal measures. And and vaccination is also, moving slowly from some countries to others, but that's likely to remain one of the driving forces of growth over the next 2 years. I mean, maybe the vaccination effort in the world will finish towards the end of 2022.
Yeah, and that will change the outlook further, I think, as well. Yeah, fantastic. Okay, well, Jose, that was all I had to ask, really. But it's been really interesting to get your very comprehensive rundown of how you invest with such a large portfolio, and also some of those major themes that are going to be shaping growth, not just for the mining industry, but also for global economies as well. So I really appreciate you taking the time to talk with us today.
No, on the contrary, I appreciate it very much that you have invited me to participate in this interview. Thank you very much, and I hope it has been useful.